All right. Next up, we have a panel on interest rate volatility, what to expect in a 0% environment. On this panel, we have Sam from Spark Protocol. We have Cynthia Wu from Matrixport. We have Sam from Scroll. We have Marcin from Redstone Oracles. And last but not least, we have Studi from Kraken Ventures. And this panel will be moderated by Lewis from Gyroscope. Thank you.
Okay, well, microphone seems to be working. It's great to be here. I'm Lewis Gudgeon. I'm the co-founder of the Gyroscope protocol stablecoin. So we're going to speak about interest rate volatility and what you could expect in a 0% environment. We're very lucky to have a great panel today. So I'll start. So we have Sam McPherson. So he's co-founder and CEO of Phoenix Labs, which is the development company that's building the Spark protocol. So Spark protocol is a lending platform, and it's a sub-DAO of the Maker ecosystem. It launched late last year, and at the last count has a TVL of a bit more than $3.5 billion. Then we have Cynthia Wu. So she's the COO of Matrixport. Matrixport's a crypto financial services platform in Asia. So their website's currently reporting about $700 million worth of loans, 5 billion monthly trading volume, and just under 300 employees globally. So one real-world asset product that they have is the STBT. So that is the short-term treasury bill token. And that was recently launched by Matrix.doc. Then we have Stuti Pandey. She's a partner at Kraken Ventures, which is a global VC fund leading their investments in the Bay Area. Before Kraken, she was an early-stage investor for Manev Mobility, Speed Invest, and Early Bird Venture Capital. Then we have Marcin Kazimierzak. He's the COO of Redstone, as well as a co-founder of Warp Contracts and Arweave. He's also a co-founder of ETH Warsaw. So Redstone's a modular Oracle system. According to their website, currently covers more than 1,000 assets and using 175 different sources. Okay, and then finally we have Sam Jernigan. So he's an official advisor and global macro investor with over 15 years experience trading a wide range of asset classes. Today he's here in an official capacity as an advisor to Scroll. So Scroll is a ZK EVM bytecode equivalent rollup that was founded in 2021. So that launched in October 2023 and has just exceeded $100 million in TVL. Okay, hopefully those introductions were accurate. Let me know if there is any gross misrepresentation. So I'll just start with a very sort of point-blank question. So what are real-world assets and what is their main value proposition?
Yeah, happy to take this. So I think real-world assets are the representation of basically any asset that is not crypto native. So can be tangible, can be physical, can be from the imagination of the traditional finance folks as well, that is represented on chain. I think one of the reasons that it is so attractive for both TradFi as well as crypto is that we have created rails to bring those kind of assets on chain while conferring these benefits of 24/7 settlement, transparency, and lower fees to traditional finance. And I think one of the reasons they're having such a big moment over the last, let's say, 6 to 8 months is because I think first, macroeconomics, so the changing interest rate environment made real world assets more interesting than crypto native assets. Technological advances, so this emergence of L2s and other emerging cryptography has lowered transaction fees and improved transaction speeds. And finally, crypto has gotten quite a halo from institutional crypto adoption over the last year. And kind of this combination of factors has created a ripe ground for real world assets.
Yep. Does anyone else want to chime in on what the main value proposition is of real world assets? Like why should we care about them?
Yeah, I can. I think that's pretty accurate what Stuti has said. I think the main value for us to bring the real world asset on chain is probably to expand the asset category we currently have to a much wider asset category, as well as a much bigger market cap. If we look at our current market cap, it's about 2 trillion, right? Of course, it's probably going to be 10 trillion after this bull cycle. But if we look at the other asset class that's been existing longer in the financial market, the bond market is 135 trillion, and the equity market is also more than 100 trillion. And if you look at precious metal market, that's also 15 to 17 trillion. So imagine if we can bring a fraction of that trading activity on chain to our next gen financial infrastructure, which is blockchain, and have institutions and retails participate in this new infrastructure, given all the benefit that Stuti has mentioned. I think that greatly expands the scope of our work.
Great, thank you. So the sort of main topic of this panel is about this 0% interest rate environment. So I think it would be very helpful if someone wants to just sort of talk a bit about how they understand or how they've seen interest rates develop in the last few years, maybe sort of around starting from just pre-pandemic. And yeah, obviously not expecting predictions on interest rates into the future, but maybe some sort of thoughts on the macro environment as a whole. Maybe this could be a good one for you, Sam.
Right. So I think that. So I've spent 20 years in TradFi. I worked at JP Morgan for a long time. I most recently ran crypto for one of the largest macro funds. And I think most TradFi and macro people thought that high interest rates would kill crypto. And in theory, it should also really have degraded the utility or the uptake of, say, stablecoins, because if you're holding a stablecoin in your account that doesn't earn anything, you're giving up that yield to Circle or to Tether or whatever. And obviously we see these large interest balances that they get every quarter. And so I think that that stablecoins persevered through this bear market was a huge signal, and it's very important. I think we could do 2 panels just on the importance of that endurance. And then, I thought they both gave a really great kind of perfect overview of the real world asset space. And what emerged over the last 6 to 12 months in conversations I have almost every day with TradFi people in New York is around tokenizing money markets. The BlackRocks, the Franklin Templetons, et cetera, of the world, they're ecstatic about opening up the global audience for of individuals who want to hold interest-bearing tokenized assets. Again, so there should be an almost infinite market for holding interest-bearing U.S. Treasuries, and they know that, and they're going after it. There's a regulatory and a legal compliance process. There have been some smaller crypto-native attempts at this in kind of offshore jurisdictions, and some of them have presented here. But the largest global asset allocators and banks are also looking at this, and they basically have to. And so I think one thing you should think about is if stablecoins didn't go away, despite the fact how high interest rates are, what's going to happen when they come back down? And that cost of carry, the cost of carry being that lost interest income you give up by holding a non-interest bearing stablecoin, what's going to happen to the size of stablecoins when interest rates come back down and effectively there's no real positive yield to holding dollars, basically? My guess is that stablecoins will have a significant boom globally when interest rates come back down. And I think you'll still see a demand for money market, U.S. government money market and treasury funds as well, because you've now opened up a global audience that previously had a very difficult time accessing U.S. dollar denominated interest rate yield.
Thanks. Perhaps, Sam, do you have views on whether real world assets are sort of killing crypto, or are they bringing in yield?
Definitely not killing crypto. I think it's quite the opposite, actually. So without real-world assets, yeah, we're completely constrained to crypto-native assets such as ETH and Bitcoin, which are the big ones. So that only has so much scale, and so to scale up to traditional finance scale, like RWAs are just a necessity. So like it's going to happen no matter what. These high interest rate environment that we've seen over the past year or so has just been a huge forcing function to make this happen. And you can see this in the evidence of the tokenized T-bill markets that have gone from basically zero in the beginning of 2023 to now, on the order of 700 million or something. As well, Maker's been a pioneer in the RWA space. Like from the beginning, the project has always been very clear that it's going to be backing itself with RWAs so that it can scale. Again, so there's this stablecoin trilemma where you cannot have scalability in your stablecoin without assets backing it that look like the underlying. So for a USD stablecoin, you need to hold cash-like assets on your balance sheet if you want to scale. So Maker's been doing this from the start, and over 2023, it was ramping up its RWA backing from, it just was at the beginning, again, it was like more like 200 million-ish, and now Maker is backed by about approximately 2 billion in T-bill backing. And this yield has been really great, so all the stable coins have been making a killing in return right now, like Tether's making a huge amount of money. Maker is forwarding some of this yield on as the DSR. So the tokenized DSR called Savings DAI is great because you don't lose DeFi composability, but you can maintain this access to the risk-free rate, which is great. TradFi risk-free rate. So this is kind of like, Maker's always straddled this line in between decentralized stablecoin and centralized stablecoin, and it kind of gets the best of both worlds. So in the high interest rate environment where crypto we were not in a bull market, Maker was able to earn return on the T-bill backing. Now that the bull market is returning, Maker's backing, or DAI's backing, has shifted. It's now 50% in crypto native vaults again. And those vaults, the cost of liquidity is just like skyrocketing right now. So we see in Maker very, very high returns. So Maker's kind of built for multiple different types of environments, low interest rate environments as well as high ones.
Thank you.
We get a lot, sorry, just to add on to it.
Yeah.
I think because we have launched SDBT, which is a representation of a US Treasury bill. So we get a lot of questions from last year, especially into this year, as their expectation of interest rate probably be peaking in the next few months. They're probably going to go down the cycle. So the questions are like, would there be people still needing the tokenized treasury if the interest rate are not able to sustain at the current level? My short answer is yes, because if you purely look at tokenized treasury from the yield perspective, of course, yield is relative, right? When bear market, bull market, you have different comparison, right? So maybe that's of a different attractiveness as of this year versus last year. However, if you look at tokenized treasury from the perspective of its use as a collateral, in the TradFi world, it's used very largely as a collateral, right? When you do collateralized loan or when you do margin trading, margin financing with very small cuts, a haircut, you can get a loan on the back of the treasury. I think that's similar in crypto, right? With tokenized first being, US Treasury first being tokenized, it not only give you the risk-free interest, but also it's a very high quality and liquid asset to be used as collateral. I think that has a lot of utility in the DeFi world, right? Especially now we are exploring SDBT being used as a collateral in lending, protocols, as well as that being used as a collateral being trading on centralized or decentralized exchanges. So I think we are still in the very early stage of exploring use cases for tokenized asset. That hasn't been really been taking quite, it's just been starting, and I think there's still a long way to go in that direction.
Great, thanks. And Martin, what do you think? So when interest rates go to zero, do you think sort of real world assets will lose their main value proposition in crypto, and everything will just fall apart.
1-1, all right. Yeah. Thanks for handing me the mic. So from my perspective, REST is an oracle, right? So when you need an oracle in DeFi, like you don't offer an oracle to like traditional companies usually, because it's all about like decentralized lending, decentralized perps, decentralized options, CDP stablecoins, and so on and so forth. So oracles deliver usually the market price of a given asset. So as Cynthia was mentioning, like real-world asset-backed stablecoins right now are used all across DeFi, right? And then you can have various approaches to how to price them. You can assume they are, for example, $1, or they are $1 multiplied by the exchange rate of the accrued value over time. So like as DAI is doing, so you just multiply DAI by how much like value it accrued already. Or you can implement the market data, and majority of lending protocols like this kind of an approach because they use oracles for liquidations. So when there is like a liquidation happening of a position, they go to decentralized exchanges usually, and they try to sell the collateral in order to pay off the loan. But before I go even deeper, like answering the question, let me first ask the audience to wake you up a little bit. Who has ever held RWA-backed asset in your wallet? Raise your hand. Okay, so let me say it's like 15% to 20% of the audience over here. And the second question would be who holds right now? So who has decided to, exchange it for another asset? And I assume there are people right now in the audience that in the craze of right now the bull market upcoming, decide to drop, let's say, the real-world asset-backed stablecoin with like native yield of 5%, 6%, to go to, for example, liquid staking tokens, like exchange it to ETH and then go to liquid staking token or liquid restaking token, because right now the market is like, heating up. So my view, personal, on like when RWAs are going to be zero, if ever, my view is going to be for the evolvement of this space of like DeFi and whole crypto. It's super important that we keep the progress, like involving them into the assets. But over short term, whenever there is like a bull market approaching, users are just trying to ape and find the highest yield. I mean, I'm talking about regular users like retail and crypto degens. I'm not talking about big institutions because they chase a bit of a different market. So short answer, it's going to stay. And I see RWA in the crypto is like a wave that is slowly like going forwards. And it's the only way to push crypto to like the mainstream, because as Sam mentioned, like there is like right now a boundary of market cap of ETH, of Bitcoin, and the traditional finance world is like almost limitless actually, like because you can print dollar as much as you want.
I want to add, so like specifically about the question of are RWAs going away when we return to a 0% interest rate. I want to respond to this with, the spaceman meme always has been, because the RWAs always have been one of the biggest killer apps. Centralized stablecoins. Tether's been around for a long time, and it's like one of the, it's just a very dominant use case, so yeah.
So I think, is this working now? Yeah? Okay. So I think a key aspect to this question, we have to take into account the design of the RWA. And one of the most important things is composability. So if an RWA is not composable, and let's say it's a tokenized treasury bill that is offering yield, and then yields drop to zero, then this is now useless. However, let's say that the RWA is a stablecoin that is backed by treasury bills, right? And now yields drop to zero, there's going to be multiple downstream effects. So what this means is our risk-free rate has essentially become very cheap. So I was looking at an interesting chart, I think it was by the Bank of International Settlements, that was comparing the spread in SOFR as a proxy for the risk-free rate and Aave lending rates as a proxy for on-chain yield. So basically when that spread is positive, you can essentially make money by taking out money for the cost of almost zero, right? Minting stable coins, bringing them on-chain, taking them to Aave, in the bull market make between 5 to 15% just for lending them out. And during that period, stablecoin issuances boomed. So the key point here was the composability. Okay, so then after that, 2022, these rate hikes started to happen. right as these rate hikes started to happen, this spread started to flip negative. That is exactly when stablecoin issuances started to come down. So I think some of the takeaways here is, well, one, I think that RWAs, depending on what they are and how composable they are, as long as they maintain par or higher spread than risk-free rates, there's still an opportunity for crypto products. And then the next thing is basically building products that are rates resistant, which is why I think actually, Spark and DAI, I think have particularly interesting designs in which the protocol can still be sustainable depending on, or regardless of which direction rates move in.
Great, thank you. I mean, I guess also maybe it would be worth talking about another key piece of this puzzle, which is like inflation and inflation expectations and how this like affects what the central banks will do and sort of, their expectations about the future performance of the economy. What do you guys think? Like, are we entering this period now of like sort of lower inflation or deflation? Do you think that this is going to provide an environment where it's sort of safe for the central banks to lower rates? Maybe no one wants to provide macroeconomic forecasts live.
I think we were talking about this earlier, I think we're in a very awkward period, right? We were predicting rate cuts, but that's also because we were predicting at least a mild recession in this year. But unemployment numbers are not that bad, and actually inflation is still pretty high. So I think, central bankers are definitely in this pause period on their plans around rate cuts. And I think this introduces like this awkwardness because we're neither hiking nor are we cutting, and we still have this inverted yield curve. And usually the yield curve is a prediction of recession. There's maybe one time that it hasn't predicted recession, but right now there aren't, like the yield curve is not giving clear guidance either. So not super definitive, but I think the answer is this is a really awkward period, more awkward than past periods that we've seen pre-recession.
Any other volunteers for a macroeconomic forecast?
Well, I think what I would say is, when I started the first macro fund that could trade crypto, and I think that Bitcoin is an asset that should be sensitive to higher or lower rates because it's a non-interest bearing asset. But I think that I would encourage most crypto people to kind of, and again, this is coming from somebody who's traded interest rates for a very long time, I would ignore what the Fed's doing. Don't let CNBC trick you into believing that somehow, 25 basis points up or down is going to, massively inflect the future of what we're doing here. And I think the last year should prove that. The Fed hasn't raised rates. Just this year, expectations went from cuts to basically very little, and yet crypto's gone up and things are great. So don't fall into that trap, because the broader macro, macro is not just whether the Fed is hiking or cutting rates. It's technological trends, it's the movement of people, it's geopolitics. Probably one of the biggest catalysts for crypto this year has nothing to do with the Fed, and it's the U.S. election, at least for a lot of U.S. participants. So I actually would de-emphasize the importance of the rate outlook for the medium to longer term trajectory of the industry.
I think one other possibility is seeing kind of rate guidance as, I guess, people are already starting to build that into their behavior. So like, I was talking about the inverted yield curve. In the past, that's been seen as a signal for a recession. I think it's quite possible that this time around, people saw this signal for a recession and started to act in accordance with that. Whereas in the past, maybe when this wasn't as common of an indicator that people listen to, they weren't building those expectations into how they're building businesses.
One of the reasons that rates have had to stay high is because of the level of net fiscal spending coming out of Washington. So in 2023, call it the 22-23 12-month period, we were looking at over 5% to 6% budget deficits. This 24-month period, you're also looking at another 5%. And so it's very difficult to get a recession when you have that much fiscal spending. And so in effect, like the Fed is basically just like offsetting a lot of that. And so one of the probably the least talked about bullish thing is, guess what? If the economy weakens a little bit, the Fed has 500 plus basis points of cuts it can do to stimulate the economy. And so, even if the economy were to slow down, household balance sheets are in a very good place, and the Fed can cut rates, and that's going to be a positive for the economy. And those lower rates are, as we discussed previously, people will kind of start de-emphasizing on-chain money market funds a little bit, and all of a sudden stable coins are, much more back in vogue because that cost of carry is not so high.
Yeah, thanks. I think this could be an interesting point to discuss. So let's say rates go all the way down to zero. What's going to happen to stablecoin liquidity? Like, do you expect total stablecoin TVL to increase, decrease, go negative?
I think, as they discussed earlier, it'll go up hugely, right? Like, because you can earn this, you can take your dollars, which are basically just inflating away at let's call it 2% in your banking account, and you can put them on chain, and you can do fun stuff and potentially earn a much higher risk premium. And so, yeah, it should be a huge positive.
So, yeah, if rates really go to zero, then crypto is definitely back. And stablecoins are used as collateral as well as in trading pairs for DeFi. So regardless of the rates environment, issuances will be going up. But I think it actually also comes down to what the design of the stablecoin is and how yield sensitive the design is. So let's take Frax as an example. I understand that they are developing a stablecoin that is meant to essentially be resistant to yield curve changes. So for that product, they might be less resistant to changes in rates. Then you have more vanilla options like DAI, USDC, USDT. I think if rates go down, they might reallocate capital or collateral a bit, and perhaps a little bit of the revenue that comes from treasury bills decreases. But I think it'll be business as usual for them, and they'll generally have an increase in net issuances. I think finally, the group that might be most sensitive to this is really the cohort of stablecoins that came up in 2023. A lot of these stablecoins have been premised on the high rates environment, and they've looked to gain edge against incumbents by passing yield through to end consumers. So now if those rates go from say 5-ish% to even, let's say, like below 2%, that yield pass through is no longer as attractive. So I think what's important is that they remember that this was just a Trojan horse. And while rates are still high, they work very rapidly to build in integrations, to build in composability, and to gain adoption. So if rates start to fall, they have sufficient network effects. And perhaps they also consider diversity in collateral at that point. But yeah, generally, I think crypto will be booming and stablecoin issuances will be up if rates really hit zero again.
Yeah, I agree with Stuti. Just want to add on that. I think for a stablecoin, its value really comes from three fronts. One is the stability, regardless of market volatility. The second is its use case. It is widely accepted in a lot of scenarios, like for trading, for payment, for various other things. The third thing is really the liquidity, right? It's liquid. If you want to swap it into other stablecoins or swap into other assets, the on-ramp, off-ramp channel are really smooth. I think that's really decides the value of the stablecoin. The yield is, in my opinion, is really a bonus, right? Like Stuti said, like in this market, we see a lot of real-world asset, yield-bearing asset-backed stablecoin in 2023. Mainly because of the relatively high yield. I think that can be used as bootstrapping of their growth strategy. But if they cannot really achieve the three aspects that I just mentioned, probably the value will gradually diminish. So I think the time is still on their side. It's still maybe 1 or 2 years to go, given the relatively sustained interest rate level. But I think that's a really hard battle to win the mind share and use cases.
Yeah, I agree with all this. And so there's really only like as my fellow panelists said, the ones that will be most affected in a zero interest rate environment are the newer ones that people are mostly just using for the yield. And once the rates go back down, that use case is going to go away. So what's going to be the ones that benefit from it? It's the ones that have network effects. And this is by far, Tether is the dominant player here. People are using it for payments, integrations, this kind of stuff. So the other two that have achieved this effect to a certain degree is USDC and DAI. And previously, I think Binance USD had this to a certain degree, but this sort of like takeoff velocity with network effects of the stablecoin is the absolute thing that stablecoin projects want to achieve the most. This is like the golden goose of achieving this, but it's like nobody knows how. Like you're basically first to market, you get it, and if you don't screw up, you just build and build this dominance. So this is going to be the thing that benefits the most as the interest rates go down and the stablecoin supply goes up overall. A lot of these gains just seem to be going to the biggest players.
You know, the two things I'm most interested that I haven't heard come up yet, but I wasn't here for earlier panels, is I think that if we're right and stablecoins continue to gain traction and maybe that accelerates as rates come down, and I think the banks aren't going to just sit around and just let their balance sheets be monopolized by some 40-person corporate entity that is has their deposits in the bank and then is issuing a token against it. They're going to press regulators to get involved. And so you've already seen white papers by a few banks on deposit tokens. So I think, or tokenized deposits. So you're going to see that happening. It's hard to say if it's going to be in the U.S. yet. I think it's probably the best alternative to what won't happen in the U.S., which is a CBDC. I'm fortunate to be, have a lot of friends that used to work at the Federal Reserve, and part of this conversation, I'm attending a Fed conference on Friday. I don't think you're going to see a U.S. CBDC, and instead it's much preferable for a number of reasons, including for the transmission of monetary policy in the U.S., that the banks ultimately play some role where they would simply tokenize the deposits. I think you're probably will see, perhaps before that happens, a bit unclear, you're going to see either a small developed market country, maybe particularly those that have very robust financial systems where the financial systems are effectively multiples of GDP. So let's call that like Hong Kong, Singapore, Switzerland. Those countries are ultimately going to be pushed into participating in some way. And so I would not, or even the UK, I would not be surprised if you didn't see a CBDC issued by one of those countries, maybe including some smaller or emerging market countries on a permissionless blockchain like Ethereum, which has achieved escape velocity from a network effect perspective. And so that is going to be a mind-blowing event. I think it's, basically stablecoins and the proliferation, the success of that is going to push these next two things to happen. And again, like it's the banking system, both in the US but globally, just like think of all the banks, like whether it's Australia or any other country, like they're going to want to compete for savings basically, and the proliferation of and the success of their own, their own consumer base. And so I think you're going to see banks as stablecoins become, and they will need to be, significantly more, popular. But they're going to push regulators to approve deposit or tokenized deposits, and then you're going to see small countries that are going to want to tap into this global market and stay relevant for their domestic currency by issuing a CBDC on a permissionless blockchain.
Yes, I'm very happy to see that all of the panelists agree that when we hit zero interest rate, the crypto is going to rally. So yee. And when it comes to some of the points that were mentioned over here, I want to double click on stability of stablecoins, because in my view, like the very one thing that stablecoins should do is to be stable. I suppose majority of you remember the USDC DPEG and also like slide DAI DPEG, because it's backed by USDC. Actually, in Poland, where I come from, sorry that my name brought so much trouble to spell, Marcin, So
it's fine.
yeah. I'm from Poland, so for us it was Saturday morning, and I remember my fellow founders writing to me, "Hey Marcin, do you know what's happening with USDC?" And I'm like, "No, what's going on?" "Yeah, you know, I held my 100% of treasury in USDC, and right now it's like 9% less worth, right? Because there was like a moment like of 91 cents or maybe even 90 cents. I don't really remember exact number. But stablecoins have to be stable, and in my opinion, as we will be seeing like the decrease in the interest rate, people will be also analyzing the, let's say, stability risk profile of these stablecoins. So USDC naturally is mainly backed by the dollars that are held in banks, and like if one bank goes down, then part of the deposits are at risk. DAI is also like mainly right now, I think, minted across RWAs, right? So like, there's like a very big
50-50.
50-50, okay, so 50-50. So there is like a dependency on real world assets and like traditional finance, which is good. I mean, we need diversity, but also there will be options of going to stablecoins that are fairly dependent on the ecosystem of cryptocurrencies. So for example, CDPs, collateralized debt position stablecoins like Curve USD, DAI actually is also one of them. Go and Prisma, Liquidity, just to name a few. So as we will be progressing in this 0% interest rate environment, in my opinion, people will be trying to diversify in exposure to TradFi failure, let's say some failures, or the crypto exposure, like for example, Etina right now is also like a very interesting model for bringing a stablecoin with high yield and high risk, relatively high risk.
I would just say it's occurred to me a couple times in the course of this conversation. We're probably not doing sufficient justice by just delineating fiat stablecoins versus say over collateralized crypto stablecoins. And I'm a proud Maker Vault holder since 2017. So I think most of my comments have been focused on fiat stablecoins, and but I'm actually hugely bullish, and probably my most bullish view on ETH really comes down to a future where we can have a very robust, capital efficient, ETH only, governance free stablecoin. But I think it is important that he brought up those things. He also mentioned, me personally as an American, and like having a view both of the political system and like how regulators were going to respond. I was not worried about the Circle thing, but it's clear that a lot of people globally were. I will tell you, I also have had recent conversations which were surprising to me, where certain financial institutions are more interested in fiat stablecoin products where there is a trust, the bank holding the entity holding the fiat is in a trust rather than the way that Circle works, which has these different banking relationships, where obviously they may be under collateralized and you run this risk of a run basically. Whereas like there are state chartered like trust entities where the entirety of the collateral is held and not subject to being lent out, for example. And so there's been some interesting conversations I've had, a little bit to my surprise, where these firms are looking at, are aware, like they're also a little bit aware of it and worried about it, and making sure that that the products that they are building on, the fiat stablecoins that they build on, are taking this into account. So just a little bit of robustness to your point.
Yeah. So I mean, it's sounding like we've got quite a good system where, in the scenario where rates are high, you can have yield in stablecoins on chain. In the scenario where rates are low, hopefully crypto itself is growing. Hopefully this creates this like other demand case for stablecoins, which is to hold them as some other asset, so they can be used as a risk-off asset in the crypto ecosystem.
I think it is worth caveating that if interest rates go back to zero, something bad might have happened, and so just keep in mind this is not going to be a linear path. Like interest rates go back to zero, and all of a sudden things have been great the entire way. There's probably something bad, like a recession or whatever, and so like stocks have probably gone down, and people have lost their jobs, and maybe some risk appetite temporarily. has been diminished. So I think it's like just a good
Yeah.
caveat on these
So
comments from all of us.
that's where that question was going. So what if you are in this situation where interest rates are low and sort of crypto ecosystem itself is not growing? What then? Like, I guess more fundamentally, like, where should yield even come from in the first place for stable coins?
So I believe that if interest rates go to zero despite a recession, crypto ecosystem will be growing. So there's also studies that show that in recessionary environments, actually gambling increases, right? Especially if you're somebody without a job. So let's even just take that corner of crypto that people see as a slot machine. I think that actually activity on that will go up. And you still have that arbitrage opportunity between zero off-chain rates and potentially rising on-chain rates, like once stimulus is starting to trickle down into the on-chain ecosystem. So I actually don't think that at zero interest rates we'll have some kind of awkwardness where crypto volumes will be very low. And actually these diversification to new collateral, I think will be actually moving like further up the yield curve, right? So I think, if we're looking at real world assets, there might be a little more investment in, say, collateral such as like private credit, something like that. And I actually think where attention will start to turn towards is crypto native collateral, where yields will tend to be higher.
Yeah, so we went through this phase a little bit. Like previously, where did the yield come from? During like the 2021 cycle, a lot of the yield was coming from speculation and yield farming and stuff like that. But ultimately, that needs to convert into fundamentals at some point. So, if the rates go back down and we're in a recession, if all else is the same, I think the rates just in DeFi will just go down and we'll have some contraction of the stablecoin supply. But what we need to do is define more fundamental use cases for crypto so that we can get yields that are coming from sustainable sources. I don't have the answer to this, but like this is just, I think, the thing we should be focused on and really accelerating.
To the point of study, I really liked it because in crypto, actually no one has a real job, right? I don't know how you answer to your parents, like what you're doing in your life. It's pretty tough for me to explain. I'm running an oracle for DeFi projects, for degens to trade or earn yield. And to your some point, in my opinion, like high level in 2021, where the yield was coming from was actually not yield farming, but rather discovery of the use cases for Ethereum. So people actually realized that Ethereum is fucking decentralized computer and you can create a lot of fantastic use cases on top of that. So I would say it was like the very low level source of yield and it was like distributed across many applications that were present in the, let's say, early DeFi ecosystem of DeFi summer 2020 and 2021. And as we progress and we would hit, for example, zero or close to zero interest rate, as you mentioned, we need to find new use cases. And I see a huge potential in eigenlayer and restaking. So basically utilizing this crypto economic security and implementing it into other systems so that the yield can keep flowing. I'm not saying this is like the golden pill for our troubles, but it's a pretty interesting experiment where I would be monitoring very closely in 2024.
Yeah, in bull market, where does the yield come from? I think one is from asset issuance, right? There's a lot of new asset issued and the price get pumped. The second is from speculation, which is interpreted in our trading market as a funding rate arbitrage, right? So if you look at 2021, the average, like the market neutral fund that's trading basis trading and also funding rate trading, they are averaging annualized yield around 40 to 50%. That's a quite achievable level. That means that there's a constant demand of a stable coin doing this trade, right? Because Matrixport happened to be also running a pretty active SenFi lending and borrowing activity. So we definitely feel that flow, right? When interest was low, when bull market scenario, there's a lot of trading firms just come to us to borrow to trade because these are free money to take from the table. So I don't think the underlying interest rate would really be matter so much as long as there's a lot of still speculations and going on in the market. The demand of borrowing and the yield would be very much supported by this.
Great. Thank you very much. So I see that the timer has just hit 0, so I think that officially means we're out of time.
Almost like
yep.
interest rates, right?
Almost like, I guess they're almost out of time as well. Perfect. Well, yep, thank you very much to our panel for their points.
Thanks a lot.
Thank you.